Thank you so much for joining us. I'm Ashley Evans. 2018 was a challenging year for risk assets. In fact, the sell-off in financial asset prices was so broad that it virtually left no place to hide except for cash. What is the outlook for 2019? Joining us is Maitse Motsoane, who is a portfolio manager at Prescient Investment Management. Maitse, thank you for joining us.
Well, Ashley, thank you for having me.
What are some of the key themes that will have a bearing on financial asset prices in 2019, and how do you determine those themes?
How we determine those themes is quite straightforward. We carry out a survey that runs across different teams within the investment management team here at Prescient, and basically what we do is ask participants to rank a number of risk events based on likelihood of occurrence and severity of the impact should the risk materialize. So in the last quarterly survey at the end of 2018 that we carried out, 4 risks basically came out on top, which was potential slowdown in global growth, 2, transitioning from quantitative easing to quantitative tightening, 3, the rise in trade tensions and protectionism in general, which is a function of Donald Trump's ascension to the White House in the US, and finally, the rise of populism.
What are we seeing right now with the US and China? Should we expect these economies to slow down? And when, if we do expect them to slow down, when should we expect them to slow down?
So we definitely seen some softer data, economic data at that, coming out of the US and China. In essence, it is prudent to expect some sort of slowdown coming out of those economies. But the silver lining here is policymakers have been reacting to this softness of economic data. We've seen the US Federal Reserve Bank basically capitulate on the previous commitments to tighten policy. We've seen the Chinese policymakers pull both fiscal and monetary policy levers to support growth. Looking at all these things that are happening, it surely is possible for slowdown to materialize in both those economies. The question is, will it result into a recession? Probably not.
Talking about this transition to quantitative tightening, can you elaborate and explain on what exactly that means?
Okay, I think that's more a longer term plan. It seems like the softness in economic data that we've seen over the past year or so is basically stymied central banks' ability to tighten policy. So we've seen them basically reverse on the previous commitments to tighten policy. So it seems like we will be in an environment where interest rates will be lower for longer. And it's just a matter of time. Should we see recovery and growth, definitely we'll see that back on the cards again. But at the moment, it seems like it's on pause.
The classic demand-driven growth model has been fractured. Tell me more about this and how the rise of populism has come into effect.
Okay, so it's quite simple. The aim of a wage-led growth model is to increase consumption, which leads to increase in investments and productivity gains, so it becomes a cycle that feeds on itself. But what we have seen post the global financial crisis is actually wage growth. You look at growth in average hourly earnings out of the US has been quite muted. It actually tells us that the expansion was a function of cheap money that was flooding the system, right? And how that ties into populism is the cheap money that has been flooding the system has caused asset prices to see far stronger growth than wages have increased. People are finding it harder and harder to acquire assets. which weakens the stake in society. It threatens the tacit social compact whereby, based on the notion whereby the faster the economy grows, the better off everyone becomes.
Will these sorts of populist policies gain legitimacy?
It's hard to tell at the moment, but history tells us probably not. We've seen what has happened in South America, in Venezuela, going back in the part Brazil, Chile. The countless example, even Zimbabwe here in Southern Africa. So what you need to understand by populist economic policies that present easy answers to complex problems. So what this does often, they start ignoring the macroeconomic constraints, i.e. how do you deal with inflation, how do you deal with your balance of payments constraints, i.e. you increase local demand, but then it doesn't necessarily mean you exporting as much as you importing. So you end up running out of reserves, you end up not being able to pay for these imports, you end up not being able to control local inflation, eroding the currency value. So it's quite difficult to see them gaining legitimacy. We've seen how bond yields have spiked in Italy when they had a standoff with the European Commission over their budget. Similarly, we've seen how the pound has taken pain after the Brexit vote. One key area where we still need to see some punishing of asset prices is the US. And we're really waiting to see whether when this fiscal impulse that was introduced by the US administration wanes, are we going to see a weaker dollar? Are these politicians going to be found out?
So can we expect for things to get better? What is your outlook?
The outlook is a slowdown in global growth is here to stay. The key question there will be, does it go into a recession like some of the financial market indicators like yield curves, US yield curves indicate? Is it going to go to a recession? Probably not. Is it something that softens from well below trend to coming to levels around trend, which would not necessarily be a bad environment given the fact that liquidity conditions are much better compared to last year. Central banks are not tightening anymore. We've seen a number of central bankers following suit after the Fed had basically pivoted from the tightening bias to an easing bias. So looking at currently the data we have, it seems like risk assets will be supported at least in the short to medium term.
Great. Well, thank you so much for your time.
Thank you for having me.